from a timing perspective, cycles do matter at some point. You do realize things are just badly overpriced, and if you can't find a good deal, cash is better than a bad deal.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, I'm excited to have Mike Zlotnik. Mike, how are you doing today?
I'm great. How are you, Todd?
I am fantastic, and thanks for joining us. A little bit about Mike. He is the CEO of TF Management Group, and Mike has been a real estate fund manager since 2009. Mike's a retired software exec who began investing in real estate in 2000, and today he manages a variety of funds. He is also known in the circles as Big Mike due to his stature, and more importantly, he's known for his personal integrity and his understanding of financial aspects of successful real estate investing. And you also are the author of a book, How to Choose a Smart Real Estate Investment Fund. So with that said, Mike, why don't you give our listeners a bit more about your background and what all that meant, what you got going on today?
Thanks, Todd. I appreciate you having me on. And yeah, the short version, the most important thing, I'm a husband, father, a great family, live in Brooklyn, New York. We're married for over 21 years to my lovely wife, 4 kids, and a cat, the 5th child. So you can appreciate that.
Yep.
Yeah, I love real estate. It's my passion. I spent a career in software, and just realized in 2009 I was done with that. It was a great field, but I always loved real estate investing, both passive and active. So my journey started 2009, and we've been evolving ever since. So at this point, we run a family of funds, a growth fund called Tempo Growth Fund, Growth and Income Fund, Tempo Opportunity Fund, and we do one-off deals. We have a syndication, almost 1,000 doors, multifamily in Indianapolis. We take a substantial position. So from time to time, we'll do one-off deals. But our funds are funds of funds, the way to think about this. So we invest into a lot of deals with sponsors and operators like you, basically specialists. So we have broad range of investments, multifamily, self-storage, some industrial, distressed debt, performing debt, as well as latest trend, conversion of hotels to affordable multifamily housing. That's been kind of COVID-created opportunity. That said, just operate as a fund manager, enjoy what I do. We try to pick the best and the brightest sponsors and decide which deals we invest with and we invest in and how much money we invest. That's the exercise. So it's a portfolio building. And I'm a finance guy, mathematician. Love anything to do with finance, structuring deals, and raising capital, all that stuff.
So when you started investing in real estate in 2000, what were you focused on when you first started? And then why did you switch to the kind of the model you're in right now?
Sure. So I started pretty much only passive, buying apartments and houses in New York City. And you can only buy so much, run out of cash pretty quick. This stuff doesn't cash flow. So yeah, it's kind of New York City investing, and it's been pretty much all appreciation game. You don't get much cash in cash, but so I kept doing it passively until I went kind of full-time 2009. That's been the play. The few years before 2009, before kind of the correction, 2008 and 9, it's gotten harder to find anything useful. Everything was overpriced. So at that point, kind of stalled for a few years from, I think I picked up anything from 2006 till 2009, and then we started investing again after things sort of corrected. So from a timing perspective, cycles do matter at some point. You do realize things are just badly overpriced, and if you can't find a good deal, cash is better than a bad deal. So
so too expensive, and so you weren't finding deals. It didn't make sense. I get a lot of people that ask, like, is it too expensive now? Prices have gone up drastically. Prices from 2000, 8, 9, 10. We were paying, 20, 30, 40,000 a door, and those same properties are trading for, 80 to 150 a door. Uh, is it too expensive now? Does it make sense to continue to buy?
Yeah, it's a great question, and there is no straight answer to this. So you could make the argument that interest rates have been falling over so many years, and the falling interest rates essentially compress cap rates. There's a correlation between lower cap rates and low interest rate. Not exactly the direct relationship, but pretty close. So as interest rates have been falling, the cap rates have been contracting. The same thing has happened with the stock market. They call it PE expansion, price to earning ratio have expanded. So in a lower and lower interest rate environment, the price of the asset relative to its cash flow has been, that ratio has been increasing. So it's all relatively speaking. So can't go against the Fed. The Fed continues to print a ton of capital, and the capital has to go somewhere. And the interest rates are still positive, but they may go negative. So the consequence of this is, what is the alternative, right? So if you can't find alternative and you're sitting on cash, at some point you pick your battles and you put some money to work. So is it too expensive? It depends. I do like substantial value add strategies. So if you invest into an asset at a, let's just call them full price, retail price, you're paying full price for the asset today. You're pretty much speculating today on two things. One, that the interest rates are going to continue to go lower into negative territory. And there's a good correlation that it may happen. There's a good probability it may happen, because US is going kind of the Japan model. And that will effectively lift the value of the asset. Two, inflation in terms of rents, ability to raise rents over time. So if the rents can, basically, if the value add strategy can push the rents up, that's your primary mechanism to increase the value. Relying on the interest rates going lower and the cap rate compression is too speculative. So I would say projects with the ability to push the rents, and there's pretty good data for a given area, is worth looking at. Otherwise, the risk-adjusted returns don't look great to me. The only saving grace would be lower interest rates, as I said. So risk-adjusted return is a holy grail of this, and today it feels like, at the current valuations, you have to be extremely careful. So buying retail is hard. Value add is the key. The right value add is even more important, and ability to execute a good strategy is critical. So you're buying at the peak of the market, and you have to be pretty much aware that if there is a recession, and you might wind up with the overpriced asset.
Yeah. Although I think there's been a lot of people that saying you're buying at the peak of the market for about 4 years now. So we don't know. Maybe we can go, maybe go higher.
Yeah.
Hey, you said a couple key things there that I really have been thinking about a lot lately too. Is one of them being, where do you put your money? I mean, if you got a lot of cash and it's sitting around, what do you do with it? And the other part of that that's really important to be thinking of is inflation. And we've got a lot of money that's been poured into our economy. And if we have a good amount of inflation, then your cash that's sitting around, well, that's drastically losing money. And hard assets like real estate and other opportunities are probably a better place to be putting your money. So yeah, it's difficult, but I agree with what you said. If you can find that value add opportunity where you can create something, that's going to be a lot more safe especially than sticking your money under your pillow.
Yeah, so I'll give you some feedback on a couple of things you mentioned. So a few ideas. Number one, the asset inflation, the essentially real estate and stock market. You do see kind of the escalation of the prices, but the CPI inflation is not there. So at least it's almost difficult for most people to understand. They use one word, inflation, but you have a very weird phenomenon that the CPI inflation is low while the assets are inflating relative to because of the Fed policy.
Yeah.
On the other side, what to do with the money? Again, you could keep it cash, or you could have sort of again, without advocating the strategy, I'm sure you're well aware, but I just got off another call with a good friend of mine who does infinite banking, and essentially it's a whole life policy. So you could park your cash through a whole life. get some rate of return and get access to cash. It's just one of the techniques folks can use. Again, I use the policy from time to time, and know many people who do it. You can't overdo it. Let me put it this way: you could do a little bit, but you still have to diversify. It should not become a massive part of your portfolio, but it can do something with cash. The other place you could put cash in some short-term, loans, depending on what you can invest in. If you have opportunities to park the cash somewhere with decent yield at a reasonable degree of safety, maybe better than writing, an aggressive check into a deal that you can regret.
Yeah, I agree. Hey, real quick, I just want to let you know about the multifamily challenge that we got going on. It's a 5-day multifamily challenge on how to get an offer in quickly, right? So we're going to teach you in 5 days, 5 1-hour sessions. We're going to go through the steps in the process to get there. So go to mfichallenge.com, mfichallenge.com. You can sign up. It's free if you want the VIP. There's a bunch of things that we'll give away too. You do have to pay for that, but hey, it's going to be well worth it. Again, you can get in for free. We're going to teach you how to get that offer across the table, get the LOI in, all the steps. So Ellis Hammond and Ellis was episode 316. Check out his episode. And we're going to be doing this next week. So sign up now at mfichallenge.com, and get in there. We're doing it next week, and it's going to be awesome. So hope to see you there. You mentioned these hotel to multifamily conversions. Explain, where you're seeing those, or how do those opportunities, how's that working?
Pretty basic stuff. Pandemic, hotels have been hurt, and probably one of the most hurt sectors. Depending on the type of a hotel, it can be acquired at a well below the reconstruction cost. So ideal targets for the strategy are kind of extended stay hotels, residence inns, they look like small apartments. And you have to pick it in the right area. Ideally, you want it to be in the residential neighborhood, so it fits in. The conversion almost naturally blends the conversion into a multifamily housing. Affordable housing is a big trend. The high-end housing is oversupplied in many markets, while the affordable is in high demand. So that's something to pay attention to. You could convert any hotel to multifamily, right? If it's in the right location, you could do luxury. I mean, we just did a deal in Ogden, Utah, converted a kind of boutique, really high-end hotel to multifamily, and it flew off the shelf way ahead of the pro forma. It's a possibility, it can happen, but it is an aggressive play today. The more conservative play is to pick up some of these extended stays. Where do you get them? That's a holy grail question. You need relationships. So I can tell you that a few deals we're investing in, this relationship with basically foreclosing bank. So these hotels have gone through foreclosure, and upon foreclosure, the bank wants the monkey off their back. So if you have banking relationships and they are foreclosing, and you can complete the foreclosure, you could buy it off their hands, immediately after that. Distressed debt. So from what I hear from some folks, they're looking to buy this distressed hotels paper and then complete the foreclosure. That's a way to get ahead of the curve. Yeah. So other than that, I can tell you that you could look with the precision, essentially. If you have a given area, zip codes, and drive around the city, look for the hotels that look like they are semi-empty, the right size, 80, 90, 100 doors, nothing too big, nothing too small, maybe more. But you could get to the manager, to the owner, have a conversation, figure out if they're open to the idea. If they're suffering as a hotel, maybe you could either partner with them or acquire it from them to convert. So,
are these operators doing low-income housing tax credits on them?
Yeah, it's a great question. If you can, that would be great. In general, you have to, it's a political question with the city, right?
Yeah.
If the economics work without tax credits, you can move forward with it. If you can get tax credits as a benefit, great. I've looked at a number of conversion projects. They don't make any sense without tax credits. Then the answer is obvious. I literally have a project I'm working on right now, and the primary sponsor is working with the city, with the politicians, to get the grants, the credits, the state, the federal the city, anything that because the project without that support doesn't make enough sense. With that support, it makes great sense because it's a big difference if you can get substantial credits. So you got to kind of look through the um, that what you can get realistically and what is speculative. If you can get enough, again, you can have tax abatements, you can have tax credits, you can have city development grants, you can get redevelopment grants. There's all kinds of programs, and if you're well connected and you can get support from the town or a city, you could make the project kind of a public-private partnership where you can still make good return to you and your investors, and at the same time help the city execute the strategy like
Right.
rejuvenation of downtown.
Yep. Yep. Makes sense. Um, what are some, so you got a fund of funds, basically you're raising money and you're taking those dollars and putting it into operators that you know, like, and trust. What are the things that you're looking for in those operators, in those deals, that you want to just make sure are checking the boxes?
Yeah, it's another great question. So we've been doing most of it in relationship. So we start with operators that we already know. I mean, that
Yeah.
ecosystem is pretty strong. Can't take all business at all. Like if somebody were to reach out and I have no idea who they are, first question, who referred you? If you can't communicate that, it's just not going to waste time. But if somehow folks come on a strong referral from a well-known party, at that point we'd like to know them. We always start with the person. Integrity, background check. One of the things we've been doing recently, just running some background checks, making sure there's no funny business at all. But if all that passes, you can demonstrate integrity, obviously high competence in whatever your strategy, and then also we look at operators who want to raise small institutional and professional money with institutional and professional waterfalls, not interested in folks that raise capital with mom and pop waterfalls. I mean this with all due respect. So the product, whatever offer, whatever the deal, it has to have the what I call them kind of the right risk-adjusted return. So the balance between what the sponsor gets and what the manager gets, the economics have to be right. There has to be substantial alignment of interest. What I don't like to see is when the people charge a ton of acquisition fees and other fees, and then the investors take all the risk. So as long as you can demonstrate that you are a sponsor looking for I call them small institutional capital, and you're open to give the right terms, we can look at working. Then strategy, right? What is your strategy? Why do you believe it's the right strategy? Do you have capability to execute? And if we pass through all these hurdles, that you're the right sponsor, no like and trust gets there. At that point, we start chatting about what projects you got coming up, and then what capital we can write and what are the terms. We're not opposed to doing side letter and investing in a deal or a co-GP or LP with the side letter terms. You can raise a capital from other folks, and I call them mom and pop with all due respect. It's just non small institutional players, and it makes sense. We were open to do anything that makes good sense. In some cases, we've done some, instead of just going into common equity, we've done some preferred equity. Some cases we've done bridge just to see how people operate. Also, ideally, would like to see an operator with third-party administration. We use Verivest, and we like when people are on that platform. If you use another third-party administrator, it's an important piece. And people ask why? Why can't I do the books in-house? Well, the Bernie Madoff, a lot of people are spooked by the nothing wrong with in-house accounting and bookkeeping, but some people do that. But it feels better when there's a third-party administrator. So it's kind of something that I like to see.
Yeah, no, that makes sense. It just, when you have third party disinterested, you know, that can actually relieve a lot of stress. We do that with some of our contractor relationships, with some of our management relationships, just completely disinterested parties that are looking over some of the operations. Explain the mom and pop versus the institutional, so our listeners can understand what you're talking about. Like when you talk about the fees and the splits, what are some of the things that you see on the quote unquote mom and pops versus the institutionals? And you mentioned the waterfalls specifically.
Sure. So um, institutional. So I'll give you an example. Typical institutional spread kind of high quality fund would have 8 pref. Depends on the strategy, right? The strategy matters.
Yeah.
But let's use an example: 8 pref and an 80-20 over 8. 80 to investors, 20% to the manager as a performance fees. Light on acquisition fees, 1-2%. Light on annual management fees, typically 1-1.5, maybe 2 in some extreme cases. And then alignment of fees, again, no crazy development fees. Got to look at the mix of fees. Disposition fees, if you start seeing a lot of it.
Yeah.
Yeah. So the lightweight sponsor, light asset acquisition fee. So give you an example of a Tempo Growth Fund waterfall. So you can actually see we have 8 pref, then 80-20 over 8 on a Class A units and 70-30 on a Class B units. And then we charge only 1% asset acquisition fee, no other fees at all, no capital raising fee, no development fee, 0 other fees, and then 2% annual fund management fee. So it is sort of a light. It's not, 0, but it is something that we are very motivated. We have performance fees, and 2% keeps the lights on. Now, and then the 1% asset acquisition fee helps us underwrite the deals and just cover that overhead. That's it. The rest is back-ended. We got to have the stuff perform to earn a performance fee, because it's 8 pref cumulative until all pref is paid, return of capital, and then now let me show you kind of some of the bad stuff. I'll look at deals that have very substantial upfront fees. Asset acquisition fees could be ranging anywhere from 2 to 6%. On top of that, I've seen deals that have broker-dealer fees and capital raising fees. They add up 10, 12%, ton of fees.
Wow.
Then they have exit fees. And on top of that, you'll see a waterfall like an 8 pref and then 50-50 over 8, right? And somehow they get the IRR to the high teens. I don't understand how possible that even possible, but
not in today's market.
Yeah, and it often gets even worse. They pay 8 pref even though the assets don't generate the income. It is crazy. It's like a Ponzi scheme. So I wonder when they're going to collapse.
Yeah.
Right. So that's an example of extreme, and there's stuff in between. You basically, I want to see alignment, and the sponsor has enough kind of meat on the bone to eat. At the same time, they're not getting fat while at your risk, expense.
Yeah, no, that makes sense. Do you like waterfalls? You hit a certain threshold, the GP now starts, getting more.
I think you're referring to the IRR hurdle.
Yeah, IRR hurdles. Yep.
Yeah. I don't mind. I actually number of deals we have. Give you example some of the hotel conversions we have. We are an LP, so we have off the top of my head. We have one deal that has 9 pref, 75-25 until 18, and then 65-35. So I don't mind if you get investors to a high target like 18. Can they shift down? Yeah, absolutely. It's not a crazy requirement. Not a crazy request by the sponsor.
Let's talk about. So we talked about working with GPs. Let's talk about working with the LPs. When in creating those relationships, what are some of the things? Obviously, you've built a fund, built a couple funds, several funds. That's what you're doing. You're raising a lot of capital. What are some strategies that somebody kind of newer coming into this that wants to start raising capital? Let's say they have all the knowledge already and they're ready to start putting their knowledge to work. Maybe they've already invested in many assets themselves with their own money, but they want to now bring on limited partners. How do you find that money? Where do you go? What do you do?
Yeah, I mean, it's a long discussion. There's many strategies, right? But I will start this. So if you're going to capital raising, you always start with your sphere of influence. Always go to your friends and family. So before you go crazy trying to raise capital from people who don't know you, start with people who know you. So ask them the question, go to your list and say, if I were to have this syndication, if I were to have this fund, would you invest with me? And just give them some framework of what you think the returns could look like.
Hmm.
So you go to
Yep.
your ecosystem and then you ask for their soft commitment. Two, who else do you know? Who do you know that I should know? Right? You ask for referrals as much as you can. That strategy is always a viable strategy. Even we go back now and think, can we go back to our current investors again and again and ask for referrals? This is something smartly, right? Asking for referrals is not the technique, but one technique, hey, if you have a book, send 3 copies, let them pass 2 to friends.
Hmm.
So
Give them something of value.
yeah, give them some of the value and then let them share with people who might benefit from the same value. So once you go past your friends and family and referrals, you need to establish kind of relationship with influencers, right? To whatever ability you can, is there somebody you can partner with who has got a pretty substantial tribe? If you
Yep.
can join a tribe where there is capital already, you're now accelerating your own capital raising by the degree of the tribe. You will obviously have to share, you have to pay something, or you have to give some equity. But if you can partner with the tribe leaders who have an audience, that might help. Um Continuous education. I mean, there's an expression: he or she who educates dominates. So if you have a good strategy, um, write a book. I mean, build authority. Dan Kennedy is a brilliant, marketer, as you know, who is Dan Kennedy. He talks about ACE: authority, credibility, and then E can be exclusivity or experience, right? So if you have to build at least authority, credibility, and let's just say experience, so people can actually understand and appreciate you, and then whichever way you feel education is right. So webinars work. I like on-demand webinars. You obviously got to get to the crowd, right? So how do
Yep.
you get to the leads? The key is build your follow-up system. It's one of the things that we've done is we've built Infusionsoft based follow-up system. The capital raising, wide majority of it is in the follow-up. Probably you can raise 95% is in 5% in the first touch, not even that, probably less. 95% in the follow-up. So
Yeah.
you gotta just keep following up relentlessly, stay engaged, and that helps when you have a deal and you have a fund. But you can't put a fund ahead of that sort of ecosystem. You're better
What
going to influencers and working with them rather than just trying to put together a fund.
What do you do for follow up? Is it maybe you have that first phone call. Do you have a is it continuous phone calls? Is it emails? What is your follow up?
So this is work in progress, continuous evolution. Uh, Emails, but you don't want to spam, right?
Yeah.
You
Yeah.
what we are doing today, and we're trying to be careful. We're trying to be flexible and adjusting. We're doing sort of a weekly email, soft, nothing crazy, and then I have a podcast coming out every week. So we just let them know here's a new podcast, and then some other update. If there's a newsletter out or something else. Obviously, we're moving into the couple of other ideas with these deal room kind of updates, like what's the latest deal, something that came back, something where we're funding, give investors a little bit of that.
Yep.
So email is one technique. I mean, we're discussing potentially initiating texting, which is intrusive. And it's soft texting. It works. If it gets aggressive, it gets really annoying. So that is important.
Mm.
Um, Scheduling follow-up calls with investors is another idea. If you have an ecosystem, if you got investors, kind of checking in with them, how
Yep.
things are going. And we have a cross-product fund. So if somebody's tempo opportunity, they may want to consider tempo growth. So that discussion can help you cross-sell if you have more than one product. If you have only one product, ask for what I can do for you, and maybe they can do something for you, introduce to somebody.
Yeah. Yeah. Great advice. Yeah. I think the follow up is really important. I'm trying, we're trying a lot better to make sure we're following up with with that first initial phone call. Obviously, with your friends, family, your closer connections, the follow up is probably not as important because you're likely talking to them a little bit more anyway. They already know you really well, but especially somebody who's just reached out for the first time, or even came as a referral, that follow up is so important. If you don't follow up with them, especially somebody that's completely cold, you maybe had that first conversation. If you're not following up, they're not going to invest with you. They're just not.
Yeah, the propensity to invest, again, depending who you're raising capital with, but back to Dan Kennedy's. I love his book called No BS Marketing to the Affluent.
Hmm.
He says that the propensity to convert for affluent investors increases with every follow-up point. So on the first follow-up, on the first contact, you might have conversion rate 0.5%. On the next one, maybe 0.75%. And as you continue following up, that continues to increase, and that's the key.
Yeah.
And yeah, pushing, basically not pushing, but elevating people from a cold lead to a warm lead could be 10 follow-ups, 10 touch points. It's just a process. It's a hard process to build know, like, and trust with a cold lead. Can be years. And
Yeah.
what's really interesting is this observation. We have investors who already know us. We already have know, like, and trust, but they are just slow to make a decision. It's just the one observation I made. I've talked with a number of investors, and it is continuous touch points. And sometimes it takes a year to get that friendly investor to write the check, but you got to be in front of their face. You got to keep kind of chatting with them. And I mean, it is a game of persistency and follow up. There's no better way to put it.
It's funny that you say that, because I've had some people that, you have that, there may be a connection or even a close connection. You have a one or two good conversations with them. You think they're for sure going to invest, right? In your next deal, you stay in communication with them. They get your email newsletters, whatever else. They see that first deal and they don't invest. And then the second deal and they don't invest. And then all of a sudden, a year, 2 years, it's been even at times like 2 years or so. And all of a sudden they just invest out of the blue. You didn't expect them anymore to invest. And they just all of a sudden invest. Like you said, they're just like slow to make decisions. And they're kind of watching from the outside too. I think a lot of times you just kind of want to watch, make sure things are going good. All right, I'm ready.
Yeah, it's one is mental readiness. Two, it's personality.
Yep.
And really, I've had people who are saying, I'm filling out subscription paperwork. Like literally, I'm doing it. And then week after week and months after month passes, and they're still doing it. Okay. And a year later, I was able to get some conversion, but it's just continuous soft pushes. You got to give them space. The other thing that happens is events. So life events. Something happens, they
absolutely.
sell something. And then when it happens, they're ready to make the move. And if you're not in front of them at that time, and they're thinking they got some money to invest, and another message shows up, I mean, that's the point about persistency. You got to be in front of their face. As long as they keep you on the list. The other thing that I like to do is to add some humor, kind of not to pollute them with too much information. I see too many newsletters, and we do once a month, but it's hard. There's massive information overload. So if you give them a short email with a couple of news and some humor, it feels like it's better than a white paper with 10 pages of great content. They just don't have the freaking time to read that stuff.
Yeah, they look at it and they're overwhelmed, so they don't even look into it any farther. They just it maybe even goes into their future reads, but they never end up getting to it.
Yeah, it's called shelfware. All these great when it was in the software, we call it shelfware.
Yeah.
You buy a bunch of software packages and they're all great and all do things, but you never wind up doing anything with them.
Right. What's what's a mistake that you've made along the way here, and how have you learned from it? How can you bring some value to our listeners with that?
Let me think about it for a second. You know, there's originally I'm from Russia with love. Originally, I grew up in the former Soviet Union. I can't, there's a Russian old saying, measure 7 times, cut once. So when you're making a multi-year investment decision, you got to really do your due diligence. Sometimes you'll make a decision and you invest into something and you're really stuck. So I would say one of the mistakes, we deal with it every day. We made some investments that look great at the beginning, and then they don't pan out. But I could tell you the one thing I've learned from from underwriting and investing and doing this again and again and again. There's a one holy grail that you just can't violate, and that's called diversification, because you never know what's going to be great and what's going to collapse. And we've done well because we've diversified well. I have deals that 3-4 years down the road, they are great deals. They look phenomenal originally. They had pro forma IRR in the 30s, and it's a self-storage ground up, and boom, it happens to be Houston, and the Houston market got saturated. So you're 3-4 years down the road, you lick your wounds and you exit with slight positive return, but it looked great in the beginning. So we've had deals when I never thought there'd be home runs, and they're home runs.
Yeah.
So the only way this can work is to build a good portfolio strategy and diversify.
Yeah.
So of all lessons, you can't be perfect underwriting each deal. I mean, this is why I go back and I say, well, could I have done better job underwriting the deal? And the answer is yes, I could have done better job. Hindsight, right? We shouldn't have invested in the deal. 4 years down the road, you're getting 2% return per year, right? It's terrible, but it could be worse. You could lose all your money. The deal could go completely sideways. But the only way you could save your face is if you diversify and you spread the risk, and you wind up with a bad deal, but you have enough good deals to cover.
Yeah, I mean, and there's one thing about being smart about underwriting that's definitely critical and key, but we are also future telling, right? And you can't tell the exact future. You can't exactly tell that we're going to have overbuilding in Houston to what extent. We don't know exactly. And so there's certain things that you can do, and there's other things that we can't predict what's coming 5 years from now. We don't know what political forces are. We don't know if there's a war. We don't know, what exactly is going on. If interest rates go to 10%, we don't know that, and we can't underwrite in the future. So yeah, you got to be smart about it, but you have to understand there's still limitations to it.
Yeah, great point. I love, if you're going to ask me what's going to happen, I have this joke, and exactly along the same lines that you're telling me. I don't know the future. I used to have a crystal ball. It was great, but it broke, and I can't find another one for sale.
Yeah.
Right. So if you can't predict the future, just prepare for various versions of the future, and diversify among many dimensions, regions, sponsors, debt, equity, as much as you can. You may have a favorite sponsor. People might love Todd, right? And they can do a lot of stuff with Todd. And there's nothing wrong with it, but make sure you don't put everything with Todd. I mean this with all due respect, because you never know. Todd might not feel well, God forbid something happens, or Todd decides, he now wants to be a professional baseball player. I don't know.
That'd be sweet. I don't think that's happening though, but you're right. And I tell investors, I'll every once in a while get an investor too that they've got a really sizable chunk of money and they want to put it into one deal of mine. And oftentimes I'll say, well, look, let's spread that into 2 or 3 deals. And I oftentimes will give referrals to other sponsors that I really trust and I feel like would be great connections for these investors, especially the ones that have a substantial amount of wealth to diversify into. Because I agree. I mean, you want to diversify. I'm not going to go play baseball, but at the same time, maybe my strategy, one of my properties, whatever, if you put it all into one property and that property is like the Houston deal, well, now you're sitting here and going, man, I wish I wouldn't have done that. So,
yeah. And then just a quick thought on this. And the one thing I've kind of learned from, successes and failures, and sometimes we have a home run and sometimes we have, a tough deal, is that you got to build a portfolio theory. I mean, as sophisticated as it sounds, it's not, right? Think about this. If you take your invested capital and you divide by 20 to 30 assets, and you can diversify. Can you diversify with 5 and 10? You can, but you're better off with some kind of a spread, and avoid shiny objects. So operate with a plan. Start with the blueprints. Start with a plan and where are you going? What are you trying to do? If you have that with your average investment size, you will have a pretty decent framework what deals to invest in and what checks to write. Because people are sitting on $2 million in cash And I don't know, how do I invest it? Well, how do you invest it? If you want 10 deals, then you have 200,000 a deal.
Yep.
And if, as long as these deals are sufficiently diversified, you may be good. Or you write maybe a few bigger checks into diversified vehicles and smaller checks
Yep.
into focus vehicles. That's all
Yep.
it is. It's not rocket science, just common sense.
Yeah, I couldn't agree more. All right, so we're going to wrap up here. I got a couple last questions, and then we'll wrap. So, what's a you already mentioned one book, No BS Marketing for the Affluents. What's a favorite book, either real estate, business book that you can recommend, and of course, not your own. We'll get
Yeah,
to
I mean, it's as crazy as it sounds, but everybody knows this book, and it's basic. Even my kids asking for it, and I go back, and I really like Rich Dad Poor Dad. It's as simple as that. It's got 4 quadrants. I actually developed my own 4 quadrants, thinking about the kind of Robert Kiyosaki's 4 quadrants. My quadrants are different. It's an investment grade, speculative, growth, and income, basic stuff. But I like that book. It's as simple as it gets. There's a number of corporate books, and I gotta kind of think about it. But back to again, Dan Kennedy's No BS Marketing to the Affluent. That's sort of the book that I'm enjoying. The One Thing is a good book,
yeah.
and yeah, it's David Phelps. I'm involved with Freedom Founders. He's got a book, What's Your Next? So it's a kind of, it is designed for sort of dentists looking for their next thing, but it's an interesting perspective. What's your next? What are you going to do? Is there, if you made enough money, are you going to retire, or are you going to do something else? So
Yeah, interesting. So last question: what are your 3 pillars of wealth creation?
So I think I mentioned one already: diversification. Right? That's the basic concept, and it doesn't get any. I would call it primary risk mitigation strategy. So obviously, network,
Yeah.
right? Who your top 5 or your top 10 people you know. The stronger your connections, the better it is, right?
Yep.
And then continuous learning. We're not perfect. We're learning every day. The best thing you can do is learn from your every experience. People generally learn more from their mistakes than from their successes. So every day, just try to think, what are you doing? What systems and processes you're following, and how to improve them. Don't get stale.
I want to go back to network because I think what you got there, you've said fairly quickly, but you said your top 5, your top 10, and make sure you're making good connections. A lot of people, when they think about network, they think about casting this super wide net, getting everybody, and having, a lot of people don't make very deep connections. It sounds like you're talking about making actual real connections.
Yeah, absolutely. You don't want to have too many friends. I mean, you got no friends then, really.
Yeah.
You want to have relationships with people who they're providing positive impact on you, and you're providing positive impact on them, and you're going deeper. So for sure, they have to be great relationships, not broad range. The broad network, I'm not saying it's bad. It's just you got really no real friends because it's too many of them.
Yeah. Couldn't agree more. All right. So look, Mike, tons of great information. Thanks for taking us through, what your experience is, and talking about obviously the power of diversification, the authority, the credibility, all that kind of stuff. Really good information. How can our listeners get in touch with you? You got a book. Why don't you mention that book, and then how can they get in touch with you?
Yeah, the book is available on Amazon. How to choose a smart real estate investment fund. It's basically top 10 questions to ask before investing in a fund or a syndication.
Oh, cool.
You could pick it up on Amazon. I have versions of it on our website. The easiest way to remember, bigmikefund.com, just like it sounds, bigmikefund.com. And if you misspell it and you type bigmikefund.com, I promise it's not a kinky site.
That's good.
Yeah, that's the easiest way. You can schedule time on Zoom again. You go from bigmikefund.com. There's a button to click, or you go bigmikecall.com. It schedules the time. It's a calendar link.
All right.
So,
how tall are you, Mike? I got to ask that.
I'm 6'4".
6'4". All right. And you have a podcast too. What's the podcast?
Big Mike Fund podcast. You can get to the same place by
Perfect.
going bigmikefund.com, click podcast. It's a personal brand, and it kind of goes back to the Collective Genius Mastermind. I'm sure you've heard of the Collective Genius.
Yeah.
You probably know Corey Boatwright.
Yep.
Yeah, my good friend Corey. So years ago, I was thinking how to get a podcast going, and could be something fancy like creating wealth show, real estate investing show, something like that. He says, no, you're known as a Big Mike, and you're a fund manager, so call it Big Mike Fund. So it's kind of CG guys gave me feedback, and again, I give Corey a lot of credit. The book was written with help of Corey. It's kind of recorded the book through an interview, and then it got transcribed.
Cool.
So bigmikefund.com is where you find everything.
Awesome. Well, Mike, I really appreciate it. Thanks for joining us again, and you have a fantastic rest of the day.
Thank you, Todd. I really appreciate it.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.